On behalf of Nirmal Bang Equities, we welcome you all to the Q2 FY20 results conference call of IFB Industries. The management is represented by Mr. Prabir Chatterjee, Director and CFO, Mr. Raj Shankar Ray, CEO, Home Appliance Division, and Mr. Arup Das, Head Marketing, Engineering Division. I now hand over the call to the management for their opening remarks, post which we can take questions. Over to you, sir.
Thank you, Chirag. Good afternoon, ladies and gentlemen. Welcome to the second quarter FY call. With me, we have Mr. Raj Shankar Ray, CEO of HAD Division, and Mr. Arup Das, Head of Marketing Division, Engineering. The company during the quarter has recorded a total income of 694.96 crore, a growth of 5.5% over the corresponding quarter of the previous year. The EBITDA margin stood at 7.5% during the second quarter compared to 6.7% for the same quarter previous year. For the year, company has reported a total income of 1371.74 crore, a growth of around 9.5% for the same period of the previous year. The EBITDA margin stood at 6.1% for the YTD period to September, as against 6.3% during the corresponding year. During the second quarter and the year as a whole, the engineering growth was subdued because of the sentiment. The market and the auto industry is not doing well for a number of reasons, such as lower demand, the high acquisition costs, with GST, and those issues. Other than this, HAD has done better than the last 2-3 quarters. So with that, I would request you to start the question answer session.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question at this time, press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Aditya Vardia from Investec. Please go ahead.
Hi, good afternoon, sir. So my first question is on revenue growth in the washing machine business, which appears to have slowed down in the last couple of quarters. What is contributing to the same? And have we shared our plan of entering into 6.2 kg washing machines?
So, Raj Shankar here. Specific to the previous quarter, what we have done, which we have shared in the last investor call, was that we have completely done the front loader range in terms of new models. And what we did in the last quarter was that we had to ensure that the stocks in the market at dealer end were all moved out so that the new models could enter smoothly. So the revenue growth that you see in the previous quarter is because we have consciously cut down on the stocks to allow the new models to flow more freely. The actual sales to customer percentage is much higher than the revenue growth that you are seeing. That is the answer to the first question. As far as the 6.2 kg related question is concerned, yes. What we have currently decided is that we will be focusing on the profitability related issues first, and after these are fixed, only then will we think about the 6.2 kg.
Sure. And in terms of your response to the first question, hasn't there been a case that new model stocking would have also commenced, and that should have ideally compensated for any loss on account of...
So what happens is that when you're introducing multiple models together, what you want to ensure is that the movement of material from the company to the dealer end is as low as possible, so that the dealer end stocks are such that they don't carry old models. So we have consciously dipped stock at the dealer end so that all the old models move out and the new models can come in freely, and there's no mix-up in the market as far as the customers are concerned.
And is the whole exercise now complete, and from the next quarter or a couple of quarters, should we start seeing the benefit of restocking panning out?
No, we've already finished that exercise. So the ramp-up of the new models has already begun, and it will show its effect in this quarter itself.
And we should also be seeing the benefit of restocking happening. So there will be secondary sales growth, and we should end up recording even stronger growth because inventory would get replenished at the dealer end. Is my understanding correct?
Yes, you would see elements of that as well, yes.
Understood. My second question is on margin versus revenue growth conundrum. Now, in this particular quarter, we have seen margins in the home appliances business improving, but it to a certain extent has come at the cost of revenue growth. Has it been a case that we have not passed on the benefit of low commodity costs and consequently have seen some market share loss?
No, so actually the two things are not related because the revenue growth is what I explained to you on your first question. That what you are seeing as a lesser washer growth than our normal growth is simply because we have had a complete changeover in the model presentation to consumers. As far as the improvement in the margin structure is concerned, we had shared earlier that the new models, etc., that we are introducing in the market are at a much better margin profile for the company. So the improvement that you are seeing is because these models have now begun to enter the market.
Understood. And these models are purely on the washing machine side. Issues for microwaves and room AC continue for now.
Yeah, so what we have done is that for front loads, we have completely changed the range. These are new models. For top loaders, we have made minor adjustments, but not as much as the front loads. And in microwaves, we have redone pricing as well as the models both. So for microwaves, this is an exercise that began about 2 quarters back, and it is now complete. And for front loads, it is complete. For top loads also, it is complete.
Understood.
So this quarter is about ramp up of the new models.
Sure. And lastly, if you could share some insights on how you are seeing the demand scenario and competitive intensity playing out, that would be hugely helpful.
So to us, the competitive intensity is as it was before. There is no significant change. It remains as competitive as it was. As far as demand is concerned, we are quite okay with the demand that we are seeing. We don't see any sort of any impact at all on the demand. Demand is quite okay.
Perfect. That's helpful, sir. Thanks, John.
Thank you, sir. Participants who wishes to ask a question may press star and 1 now. We have a next question from the line of Chirag Sitalwar from FY2019-20. Please go ahead.
Good afternoon, sir. Could you help us understand what kind of profitability we can expect in the home appliance business for the full year? So when you look at your EBIT levels, so in the last couple of years, there's been a lot of variation from a low of 2% to a high of close to 5-6% or close to 5%. And this quarter, we've seen improvement in, as you mentioned, for a variety of reasons in home appliances. But what we wanted to understand is for the full year. So you started with the first quarter at around 2.5%, and the second quarter is with 6%. This is at EBIT level. What do you think is a sustainable level for this year and going forward, both in home appliances and in engineering from an EBIT margin perspective?
So I'll answer the appliances part, and then Mr. Chatterjee and Mr. Das can answer the engineering part. As far as appliances is concerned, what we have previously shared is that if you look at the profitability issues that we've had, and we can specifically talk about quarter 4 of the last fiscal year and quarter 1 of this fiscal year, in both of these quarters, we were very heavily impacted by the changes in the import duty structures on two categories of imports that affected us quite significantly. One was microwaves and the other was front loads. The action plan that we had shared was that we would be working on increasing profitability on our washer segment more so that it, compensates for the problems that we are having on imports. That exercise we began about 2 quarters back, and that has now been completed, like we just shared a few minutes back. As far as imports impact is concerned, on the microwaves, we have fixed the issues by repricing and remodeling the range. That work is over. What remains is the impact that we carry on the air conditioning segment, which today is a stress on the P&L. But with IFB's own air conditioner manufacturing starting from end of January, this factor will also get addressed. So, as far as the trend is concerned, whatever your improvement you're seeing will continue. We don't make a specific forecast, but what Mr. Chatterjee and I have shared earlier as well is that a double-digit EBITDA level is something that we are definitely committed to. So the actions on the washer are over, microwave is over, and the air conditioner action will be over end of January. These are the 3 things that we have to work on.
And so how far are you from achieving this double-digit EBITDA in appliances?
Yeah, so we wouldn't want to make a specific forecast on this, but with the air conditioner fixed, I think the work is done.
Sure. And as far as fine blanking, engineering goods?
Mr. Chatterjee, would you like to take the question, or are you answer?
As you are aware, fine blanking margins have dipped over the previous year. It is mainly contributing factor was the top line, because there is a dip in the top line due to dip in the overall automotive industry. Now, all these OEMs, what they did is they were liquidating the stocks which were lying at the dealer's end. So, over the last 1 month, due to the festive season, you might have read it also, the stocks have continually liquidated. Now, then comes the BS6 implementation. Now, with the advent of BS6, we are all ready with the products for the BS6 for all the OEMs in India. So, going by the forecast and understanding, we should be doing better than what we did in coming 6 months. So, with the top line increasing, I think the bottom line should also increase in the fashion we used to do in the past. Because engineering margins were on higher side in previous years.
So, and lastly, could you tell us what your CapEx plans for this year are?
CapEx plan this year is, for example, we have around 150 crores towards engineering. We have got another 40 to 50, and the routine in appliance would be another 50 crores.
Sorry, sir, that's 50 crores in appliances. 50 crores in engineering, 50 crores for normal CapEx, and 150 crores in appliances, is it?
Also, for the motor division, the motor that we are producing, we are shifting to new motors. There also would be another 48 crores investment.
No, sir, I didn't follow. So, what is the, if you could just repeat that, the full CapEx for the year would be how much?
Around 250 crores. No, around 300 crores.
Okay, and can you give me the breakup again?
148 crores for the AC plant.
150 crores for the AC plant.
Yeah. 55 to 60 for the normal one. Normal HLE routine capex.
Sure, 50 normal, that's 200, yeah.
50 crores for the engineering division.
50 crores for fine banking, yeah. That's.
And the motor division is 48 crores.
So what is this motors division? Can you help us understand?
Sir, you just explain him the switch.
Yeah, so there is a transition that will happen from the present category of motors that we are using to a new range of motors which is called as brushless DC motors. So the motor division is investing for a complete localization of the motor both for top loaders and for washers and for air conditioners, for it to be produced by IFB to service the IFB capacity and also the India capacity at large, because motors in India currently are completely imported. There is practically no good quality motor supply base within India. So this investment is towards that.
So this 50 crores can give you a revenue of how much?
I don't have an immediate answer right now. Is it possible for you to tell you this offline?
Sure. And what is the in-house consumption of motors in value?
In-house consumption, currently if you look at the motor, for example, in top loaders, the import content is about 15%. And that will get completely localized. In front loads, currently the import content would be, of the total motors that are used, about 20-odd% is imported. That would get localized. And in air conditioners today, 100% of the motors to be used are imported, not only for IFB, but almost for the entire industry. This investment will give a India option day number one, basically.
Great. Thank you very much.
Thank you, sir. Participants, to ask a question, please press star 1 now. We have a next question from the line of Sonali Salgaonkar from Jefferies India. Please go ahead.
So thank you for the opportunity. So my first question is, could you help us with an approximate market share in each of the segments that you are in appliances?
So in front loads, our internal estimate is about 40% because the external databases don't cover large parts of the sale. This is our internal estimate, 40%. In top loaders, we are between 8 to 9%. In microwaves, we are between 22 to 24%. In air conditioners, we are still very, very small, so less than 1%. In industrial product ranges that we have value share. I'm not talking about the volume there, but we have value share of between 35 to 40%. Sorry. The last category of hobs, chimneys, built-in products, etc., which we call as kitchen appliances, our shares will be roughly between 5 to 7%.
Then all of these are value shares, right?
On the front loads and top loads and microwaves, I gave you volume shares. On kitchen appliances and AC, I gave you volume shares. Value shares is only in the category of industrial.
Got it, sir. So my second question is, could you help us give an update on the distribution of yours, as in online is how much is offline, and also your exclusive distribution touch points?
So online for us is roughly 14 to 15% of sales. Our own stores, which we call as the IFB points, is also 15% of sales. And the remaining is spread between direct and indirect networks, and also an element of direct sales that we have to consumers in areas like CLD canteens, office sales, etc.
So, and how much will be our distribution touch points in terms of pan-India dealers and retailers?
Currently, our distribution that is direct and indirect retailers all put together is about 11.5 to 12,000 touch points across India.
Got it, sir. Then in terms of the demand situation right now, especially how do you see the demand in the festive season? That's the period in Navratris, and secondly, the period from Dussehra to Diwali.
We've seen good demand. In October. So there's no problem as far as demand is concerned.
All right, sir. That's it from my side. Thank you.
Thank you. Anyone who wishes to ask a question may press star 1 now. We have next question from the line of Ravindranath Nayak from Sunidhi Securities. Please go ahead.
Thank you, sir. Thank you for the opportunity. Sir, regarding this AC plant, what is the capacity you are planning? in terms
So
of
the
numbers of AC?
AC plant initial start capacity is 450,000 per annum, and with small planning related changes and upgrades, this can go up to 600,000 per annum without any capex. So we will start with 450,000 and we can easily ramp it up to 600,000.
Okay. And how much margin expansion can we see from due to this, to the expansion or market share gain we are envisaging in the AC?
So on the second question that you've asked, currently we have very insignificant share as far as the AC market is concerned.
Okay.
And once we have the plant and a complete range and the kind of positioning that IFB wants, we expect to have significant shares in the AC market in the first, let's say, 2 to 3 years of operation.
Okay.
As far as the margin expansion is concerned, there will be significant margin expansion because we've shared that the ACs have stretched the P&L, and that problem will stop once the import stops.
Okay. And whether we are planning to launch air purifiers recently, because it's for suit our portfolio?
We are evaluating it. There is no decision as yet, but the evaluation is going.
Okay. Okay. And regarding sir, this Krishan Metal, actually, what is the industry-wide exposure for this company? And it is continuing still sourcing losses. And what is the total capital expenditure we are planning for these 2 subsidiaries that we have? And the second thing is that whether we will be impacted due to the India breaking out, pulling out of itself from the RCEP deal recently. Your comment on these 2 things, sir.
Arup, you answer.
Yeah, as far as the Krishan Metals is concerned, the very inception of it was to strengthen our downstream. That means we were having issues with supply of raw material from other sources, both in terms of quality and delivery on time. So that was the first part of why Krishan was brought into play.
Okay.
There would be a cost advantage on account of in-house manufacturing compared to competition. So both these 2 factors was the basic idea for bringing in Krishan, raw material source for the fine blanking and other requirements.
Okay. Okay. So we are planning some capital expenditure to improve the profitable performance of the company. What is the plan for capex for these 2 subsidiaries?
It's under the board approval. The capex is not yet approved. The basic reason of having this capex is increase the efficiency and decrease the wastages. So thereby we will improve the margin. So that is under consideration of the board. So once board approves it, we will go.
Okay. Okay. So will we take 100% subsidiary to Krishan in near future, or we are not considering?
We have 51% as of now.
We are 51.
Yeah.
So will we make it 100% or not?
Not decided yet.
We can't say now.
That line as of now.
Okay. Okay. And sir, regarding this RCEP deal, what is your comment on the outlook for the company? Whether it will be impacted or will be benefited due to this deal?
See, the RCEP, is targeted at creating a zone where goods will move freely without any impact on duty. If you look at IFB, then by the end of January, barring microwave, the rest of the large parts of the revenue will be localized into India.
Okay.
In terms of the major components to production, which is electronics, for example, we have already localized everything into India. If you look at the air conditioner segment and major inputs like compressors, for example, there are already projects running for localization into India, which will be active, completed by, let's say, April of next year.
Okay.
So, per se, as a company, the RCEP, even though we are watching it very closely, does not have any significant impact on the company per se.
Okay.
What the RCEP will do, for example, is that it could be that washing machines which are coming in from China into India have a particular duty structure currently. If the duty, is reduced, then those washing machines effectively the pricing, etc., can be reduced by the companies out of China. But those things are not entirely relevant because those products are already being subsidized in the India market as a launch strategy or market share strategy, whatever may be the logic of the company. So if you ask me personally, I don't think the RCEP per se, as far as IFB is concerned, really has any significant impact either way. But we are watching it. We are watching it very closely.
Okay. Thank you, sir. Thank you very much.
Thank you. We have next question from the line of Rahul Agrawal from Westbridge Capital. Please go ahead.
Hi. Thank you so much for the opportunity. This question is from Mr. Raj Shankar Ray. I think, sir, you were earlier alluding to the fact that there is going to be a difference between primary sales and secondary sales because of the new model transition that you have done and you destocked at the dealer level. So what I wanted to get a sense of was that how was your secondary sales, which is your distributor to retailer sale, how did that compare versus your primary sale? How much was the gap in that for Q2 and for H1 overall?
So in Q2 per se, the secondary sales have been in the high double digits. The only reason I got off that point is because the question was raised on the revenue growth, and specifically in Q2 for issues around profitability and the new range introduction, we had to ensure that, the market was totally cleaned up. So the comment was only in that context. Actual deliveries to customers have been quite healthy.
Understand. What I meant by the reason why I asked that question was that should we see a bump up in Q3 because your secondary was robust in Q2, but the destocking would have happened and so sales growth would have been pulled down in Q2 and that will come back up in Q3? Would that be a fair way to look at it?
Yes, we expect healthy volume growth in Q3. In line with what IFB has normally been doing.
Understand. So Q2, the reported revenue growth for the appliance division is about 8%, but you are saying that the secondary sales are high double digits. So the gap, the delta there is the destocking.
Yes, that's right.
And the margin expansion, so in Q2, you alluded to again a number of factors, one of which was new models in washing machines. And you said that now only the air conditioner part is left. So X of the air conditioner losses that you may have had, where would the EBITDA margins be today for the appliances division?
Yeah. Mr. Chatterjee, please.
For example, like we used to say earlier, our margins are more in the manufacturing segments, okay, where we are doing number of steps to increase that. But because of the increase in the import duties on microwave, especially in AC, along with Forex last year, it impacted the margin terribly actually. It was pulling down. Now, if you see in the second quarter, towards the end, the AC sales are lower than the first part of the quarter. And AC now we are going into the complete manufacturing. So that the hit that we are getting, it will come into positive now. But otherwise, internally we did number of steps to see that margins are increased. As a result, you will see the expenditures are more or less contained. And we are in the right path to make better margin.
Understand. And one last question is that Q2 and Q3 seasonally are generally stronger quarters for the company. So obviously, quarters where sales is sort of over-indexed, you'll have more leverage over fixed costs. So are the higher margins in Q2 and possibly, maybe you sustain that in Q3 as well, is a reflection of that, or has there been structurally that gross margin part which you were alluding to because of the new models and all, has that played out and that has been the bigger contributor?
So the bigger impact has come from the structural change in the margin structure, and that is a result of the new model introduction and also the rejigging of the price positioning that we've done in microwaves. Over and above that, of course, in Q3 there will be a overall volume benefit, but the larger part of the improvement is because of the structural change in the gross margin.
Got it. It's not just because of the fact that Q2 and Q3 are usually seasonally better quarters, and that is why we are seeing operating leverage. I think there has been gross margin improvement as you track it.
Yes, correct.
But there out, of course, there will be some seasonal impact will be there. I will not say because, for example, normally during Diwali, Navaratri, there are some increase in sales are always there.
Which would be Q3, which would be what you'd see in Q3.
This year in Q3, in October.
Got it. So I think Q2 is not for this year because you don't think Q2 is over-indexed per se. So the margin that we are seeing in Q2 of 7.7% EBITDA, that is more due to the structural changes, and obviously AC is also under index.
Yes, correct.
That is expected to be sustainable.
Correct.
And one last question was around, I know in the last couple of conference calls, you have been saying that a lot of the effort of the organization has been towards extracting the value from the existing distribution channels to increase the number of monthly active dealers. Any update on that?
Yeah, so if you remember, the big issue that we had is that if you look at this network of 11,500 odd retailers that we have, in terms of numbers of dealers built on a month-to-month basis, when we started the discussions around this, which we also shared in the investor call, that figure was hovering around 3,000 a month. And that figure now is at about 4,500 a month. But internally, we still think that there is a lot more that we can do on that. So to us, the progress is slow. We need to do a lot more on this, and our own internal thing is that at least 5,500-6,000 retailers should be dealing with us every month. For that, this work that we've done on restructuring the sales team, reallocating territories, etc., that work is ongoing. A lot of it is finished, but there is still some work to be completed in Q3 and Q4 of this year. We'll be fully finished on this work by the end of this fiscal year.
Understand. Got it. And you mentioned that the 6.2 kg has now been postponed because you would want to focus on the profitability first. Is that a much lower gross margin product compared to your existing products?
Yes, so it was going to be at a lower gross contribution than the 6.5 kg that we have. Also, the reason why we were evaluating it because the volume potential on that is very high. Almost 50% of the industry is around that 6.2 kg capacity segment. But over the last 2 quarters, based on the internal discussions, what we concluded is that we will keep it aside for now. With the actions that we have to complete with respect to profitability, etc., we will finish all of that and then we will go back to evaluating it.
Won't this 6.2 kg machine also help you improve the dealer productivity that you talked about and possibly also more operating leverage on your sales and distribution costs?
Yes, so that was the logic with which we started off on it, because there is a logic on the volume, logic on the dealer getting volume. So all those positives are there. But it was just our conclusion that, let's finish what we have, get the exercise completed and then do this. So it's just a decision aimed at ensuring that the profitability levers are fully completed as far as the other work is concerned.
Understand. Thank you so much, sir. That's all from my side.
Thank you, sir. We have next question from the line of Abhishek Ghosh from DSP Mutual Funds. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity. Sir, your top loaders revenues have declined by almost about 4% for the current quarter on a YY basis. Any particular reason for that? Is it an industry phenomena or have we lost market share? How should one look at it?
No, there is no industry phenomena in this. In the end of the fourth quarter of the last fiscal year and early part of the first quarter of this fiscal year, we have redone pricing on top loaders, and we did it to address issues of gross margin. So there is what we think a temporary settling in required because the pricing differentials with respect to other players have increased.
And what would have been
if we look at the overall profitability, we are happy that it's improving. So this issue of volume we will fix in Q3 and Q4.
Okay. And so just to understand it a little better, what would have been the like-to-like price increase that we would have taken in the top loader segment?
In top loader, the price increase that we made over 2 steps was roughly in the range of 5 to 6%.
And in the front loaders?
In the front loaders, actually, it is totally different. It is much larger because the models were completely changed. So there is no apple-to-apple figure.
Okay.
But the new models are at completely different price points. So.
Okay, sure. And sir, if you look at our overall cash flow statement and the kind of capex that are going to incur over the next 12 months, will it be fair to assume that there will be a debt on your balance sheet given the 250 crores kind of capex that you've laid out?
Yeah, there would be some, which would be mainly because of the AC.
Sure.
Other debts also that, most of the part will take it through the internal accrual.
Okay. So
internal accrual, the reduction of inventory, those are the areas.
Okay. So there is some scope of working capital reduction is that
Yes.
What you see. Okay. And so just lastly, if you look at it, the AC, which has been the margins, has been a drag on our overall appliances margin. And as in when your own production kind of comes in, because the duty differential not being there in own production, you should be able to improve your margins overall. So at what utilizations of this AC plant will you see that, the AC margins are no more a drag to the overall margin profile of the appliances segment? What would be that kind of a point or utilization level?
See, for the first capacity of 450,000 that is available from end of January, the plan that we are working with is roughly about 40 to 50% being delivered as IFB brand's own sales within India. And the remaining thing that we are working on is there are some OEMs who are interested in buying from IFB, and that discussion is going on. The improvement in the margins that we are talking about are basically for the IFB portion of sales. So even at, let's say, 40-50% of utilization of the plant capacity, our margin levels will significantly expand.
Okay. So basically what is effectively saying that you're going to increase the asset turn by even selling it and being outside manufacturers for others is effectively what?
Yes. So for air conditioners, the decision we took is that we will try and use the assets for everyone, not just for IFB, because there is a need for localization of the air conditioner into India, and there are lots of OEMs who are interested. And as a policy, we said that yes, we are willing to service demand outside of IFB as well for anybody who is interested.
Okay, sir. Thank you so much for answering my questions and all the best.
Thank you, sir. We have next question from the line of Devang Patel from Crest Wealth Management. Please go on.
Hi, sir. Can you indicate the blended price increase you've taken across categories so that we can understand in this 8% appliances revenue growth, what is the volume and pricing mix?
Mr. Chatterjee, would you like to answer that?
You answer this, please.
Yeah. So the blended price increase, we'd have to calculate that and tell you, because on top loaders,
Roughly, I will say it is around 2 to 2.5%.
Okay. Sir, and what will be our import content after we have our own AC plant and after we have our own motors? What will the import content come down to?
So if you look at the front loaders, our import content is currently at a level of 25-26%. It will reduce a little bit and come down to 20-odd%. As far as top loaders is concerned, it is at a level of about 40-odd%. It will drop down to about 25%. And for the air conditioner segment, the motors will be 100% imported, and that will go to zero once the motor production starts, basically. So stable level of imports for front loads, top loads, and air conditioners, if I say let's say a year from today, would be roughly around 20 to 25%.
Thank you, sir. We lost the line of Mr. Patel. So please, we have the next question from the line of Rita Sahil Ramani from Invesco Mutual Funds. Please go ahead.
Hello, sir. Sir, gross margin, if you could help us understand the gross margin across your different products, what kind of gross margin you make across different products?
We do not talk about margin as such. Or give any...
In terms of your, fine blanking business versus your consumer durable business, if you could help us understand that.
The fine blanking would be higher than the home appliance division. Okay. In home appliances, definitely the manufacturing product will have higher gross margin.
And I just want to understand more in terms of your strategy. Could you help me understand your strategy, internal strategy of getting into new products like AC versus, enjoying operating leverage on your existing products where we already have a significant market share?
So if you look at it, we are not entering air conditioners because IFB has been selling air conditioners for 6 years plus now. The decision was whether IFB should continue to import and sell or buy from somebody else within India or invest itself. And it is not viable to import because of the import duty and the forex level currently. And therefore the decision was between buying from somebody else within India and investing itself. And we had shared this earlier that looking at the quality levels that we want and the kind of product positioning that we want, our conclusion was that it is much better that we invest ourselves, and hence this investment into the air conditioner project. Other than that, if you look at it, the operating leverage on what we already have has been the maximum focus and will continue to be the maximum focus.
Okay. But, in terms of AC, is it, I'm just trying to understand more from your thought process kind of view that in terms of AC, since we are still, yet to gain market share, or we are still not, above the 10 double-digit market share per se. So, what goes behind thinking in terms of investing versus, getting it from the other OEMs?
So, I just told you two things. One is the quality levels that we want between what is available from people who supply within India and what we want. There's a difference. So we will not get the quality levels that we want if we buy. And the second is the kind of brand position, product range that IFB should have in air conditioners, in line with what it already has in front loads and top loads. For us, it was a decision to invest to deliver that to the market. Okay. Also, if you look at all the serious AC players within India, all of them have their own investments and their own capabilities. So for IFB to be a serious player in a very large revenue segment in appliances, it makes complete sense to actually invest.
Okay. And lastly, in terms, you shared during the call that, we internally are targeting to reach a double-digit EBITDA margin. Is this a, 3-year outlook, or is it like a, near-term outlook? Could you help us understand more in terms of, when do you see this kind of numbers internally you're targeting to achieve? And, apart from entering new segments and also, on other sides where you also rejig your product portfolio, what are the other steps in terms of the cost efficiency which you've taken to achieve this kind of a target?
Mr. Chatterjee, would you like to take this?
The cost efficiencies, for example, material, other expenses, productivity of the resources that we are continuously doing. And for example, with EC taking inside for production, the pressure on forex and the import, especially on duty side, will come down substantially.
Okay. And in terms of timelines, or in terms of thought process, that when do you plan to achieve this kind of a double-digit margins, considering the market is quite competitive in the segments which we are present in?
We cannot give you any comments, for example, when will we having this thing, but we can only say that we are committed towards the double digit. And then we are trying in all areas wherever possible in terms of both increasing the top line as well as the cost efficiencies to reach the double digit.
Okay. That's it from my side, and good luck for future.
Thank you.
Thank you. In the interest of time and fairness to all participants, please restrict questions to 2 per participant. We have a next question from the line of Manoj Baheti from Carnelian Capital. Please go ahead.
Hi. Thanks for taking my question. I have a couple of questions, sir. First is just to take it further on the margin side. If I compare your margin vis-a-vis competition, and if I see your product portfolio, almost 51% is front loaders, and 12% or 16% is top loaders. And our products are, if I see in the market, they are priced at premium or at par with the competition. So just wanted to understand, when the competition is making double-digit margin, is it, and they are also importing some of their components. So what's the reason for the gap in margins between us and competition? Also, AC portion is just 3.5% of our sales. So is it only the import component which is impacting our margin, or is there something else?
So when you talk about competition, the publicly available benchmark is Whirlpool with respect to IFB.
Exactly, sir. I was comparing
and
with
that's right. Now, even though the AC looks as 3.5% of the revenue, its impact on the P&L is much more significant. So, to really answer your question, we will have to show you that once the AC production goes live in end of January, the impact that we have partially in Q4 and fully in Q1. And then you will see the fact that it stressed the P&L, how much of difference it makes to the P&L once we are able to localize it completely. The point that you made on the comparison about the washer, about IFB to Whirlpool is an absolutely correct one. And there are 2 elements in that. One is this area around the structure of the gross contribution, which was a work that we have completed, so that part is over. The sales extraction is a very important part of reaching that sort of EBITDA level, which means that we have a large network. There is an opportunity for revenue, and we just need to do a better job to get that revenue. So if you look at Whirlpool's extraction from its network versus ours, that is an area that we need to improve on. So this is the second point. And the third point is the point related to the drag on the P&L from the air conditioner. So the first and the third are both points that will be completed within this fiscal year. And the second, which is related to the extraction, is related to our sales efficiency. We are targeting to complete that also by the end of this fiscal year in terms of all the restructuring that we are doing on the sales team.
And sir, despite of our products being at a premium price, despite of that, in fact, we should get a delta of premium pricing vis-a-vis competition, isn't it?
But there, I add one thing. It's a Whirlpool. Their major sale is from the refrigerator.
Right.
And more is from the single door and other things. Understood? Those are in the other area actually. There is a difference in the product also actually. The product means that they sell and what we sell is little different.
Right. Sir, my second question is, like, if I see the penetration of washing machine in India, and next round of the growth will be because of the increase in penetration. And if I look at our product, it is means more plan for the premium category. Any plan to come out with a new product range which can cater to the masses or mass segment, maybe some other brand or some other SKUs within IFB? Any strategy on that?
So what do you mean by a new category? Do you mean something like semi-automatic machines, for example?
Maybe like the pricing of the product which can cater to the mass segment. Like if I see the pricing of the competition vis-a-vis IFB, and if I look at the means the growth which will be coming from the penetration level going up, which may be like to the middle class or lower than middle class. So any product which you are planning to design to cater to that segment in terms of product pricing?
Not right now. So if you look at the washer segment, and if I look at a 2-year horizon, then we have to strengthen what we have, and we have to extract more from the distribution that we already have.
Okay.
Other than this issue of a 6.2 kg, we are not planning anything else. We are planning to strengthen what we already have. If you look at air conditioners, what we are already launching by end of January next year is a full spectrum range that will address all segments of the market.
Okay.
Other than the extreme low end, which like in washers, we will not get into.
Okay.
So if you really look at it, the strategy for us over the, let's say, 1 year or 2 year horizon is that we already have a lot on our plate. And the big ticket items of getting more out of the network that we have in the market, which is a job that we've still not completed, settling air conditioners into the market and ensuring that the project delivers its targeted aims, and strengthening and continuing to grow our washers. These three itself, I think, are a big enough job for the 1 to 2 year horizon. We will always keep, evaluating new categories. Like, for example, a question was raised on air purifiers, and yes, we are evaluating it. But these are more in the nature of projects. They are not the core business targets, if I can use that word, for the 1 to 2 year horizon, because the basic profitability will come from these three major actions.
Okay. So no plan in going in lower price or lower category of washers and all, right?
No.
Okay. Fair enough, sir. Thanks for taking my question.
Thank you, sir. Participants, please restrict questions to per participant. We have a next question from the line of Chirag Fetalwat from HDFC Mutual Fund.
So can you tell us, you've spoken a few times about the drag on profitability because of air conditioners. What in rupee crores is the loss that you had last year and in the first half of this year?
Yeah, so it will be very difficult to answer a specific question like this. If you could just talk to Mr. Chatterjee offline, would that be okay? We could give you the
Sure. Thank you.
Thank you, sir. We have next question from the line of Srinath V from Bellwether Capital. Please go ahead.
Hi. I just wanted to find out this 8-9% market share in top load. Would it be on the base of the whole top load space, or are we only accounting at top load above 6.5 kgs?
No, so I am accounting all fully automatic top loaders.
So would it be right to say that based on addressable market, our market shares would be somewhere near 15 to 20%?
Yes, that's right. If you take 6.5 kg only and above, it will be 15-16%, yes.
Okay. On this monthly reordering from retail, while you had shared the kind of quantitative numbers, could you give us a qualitative feel on what measures are we taking? The couple of calls back you had said we're putting feet on street kind of to give a custom sale in the retail because the way we sell IFB products are very different from other products and so on. So in the last, say, 3 to 6 months, if there are any other new initiatives, it would be nice if you could share a qualitative feel.
So in the last 2 quarters, specifically what we've done is that the sales journey plan for a salesperson in the field has been completely automated. So in terms of knowing where to go as per a fixed plan, going there and us measuring results from that visit in terms of whether we've actually generated a sale or we've not generated a sale, whether we've had the number of visits by a sales resource in line with targets. So we have completely automated this piece. That is the first thing that has been done. The second initiative that we've almost completed is to remap geographies to manpower. So, based on a categorization of each counter in the market, looking at what is the sales potential from that, and then defining that one sales resource in that territory, should they look after 4 counters or 40 counters? That is the second initiative that we've totally restructured the manpower and that's almost complete. I think by December it will be totally complete and then, we have to just make it give us benefits in Q4. And the third has been related to when you walk into a store, you meet boys and girls who explain the product to you and we call them counter sales representatives. So we have deployed more counter sales representatives in key counters to ensure that we are adequately covered. We were represented. We have increased those numbers and by end of December we would have completed our presence in all the areas that we need to be present with our own people to explain products to consumers. That is the third initiative. And the fourth that we've done is that while we've been doing 1, 2 and 3, we are also fixing the kind of structure that is required to ensure that the AC is a success. So from simple things like if you walk into a counter and the washer is on the ground floor but the air conditioner is on the first floor and therefore we need 2 people in the store. So how many stores are there like that where we need to have additional people to actually, creating a team of specialist AC people who can go and sell to a channel that is called the sales and service dealers, which is a technical channel where today IFB hardly has any presence. Which is the fourth initiative. So these are the 4 things that we have been working on. They are still ongoing. Our target is to fully complete them by the end of the 4th quarter of this fiscal. But I would expect that a lot of the benefit of actions from these 4 will also show in quarter 4 as well, because we would have completed most of it by December. Have I been able to answer your question, please?
Yeah. Thanks a lot.
Thank you, sir. We have next question from the line of Romil Chan from Systematics PMS. Please go ahead.
Hello. Hi, sir. Sir, one question is on the AC distribution network. So how are we going to distribute the product? So will it be only own IFB points that we have or the total network that we have? And what will be the working capital? Will it be very different from the existing appliances for the AC category?
So the distribution will be on the complete network that we have. And in fact, with the air conditioners, we should be able to get into new distribution networks as well because the AC is a much wider distributed product than for washers, for example. So there is no specific limitation of channel. We will have it everywhere, wherever we are able to place it. As far as the working capital is concerned, actually our working capital situation will become better because a lot of inventory gets blocked as far as imports is concerned in finished good form. When we are actually manufacturing it, our internal thing is that we might actually release working capital on it.
Okay. Thanks for that, sir. And last question is on the recent press release that we had on acquisition. So we had done an acquisition of IFB Automotive Private Limited. So can we get some data points in terms of the profit and loss, capital employed, and why we have done it, and the way going forward we are integrating the business? So if you can give some details on that.
But I would request you please talk to me separately. I'll give you the background and the details.
Okay, sir, I will do that. Thanks.
Thank you. So we have next question from the line of Nirav Vasa from Anand Rathi. Please go ahead.
Hello, sir, and thank you very much for the opportunity. My question pertains to the capex of 150 crore rupees that we are planning for the air conditioning segment. I just wanted to understand what can be the payback period for the same, and also I wanted to understand how can we play a mix of both OEM as well as a contract manufacturer for other OEMs, because in a way we are competing with our own customers. Awaiting your reply.
Okay. So the payback for this will be 3 to 4 years as per the internal calculations that we have. As far as the second question is concerned, if we were dominating the air conditioner as a category, then I think we would have had this worry about competing with our own customers. But we have looked at it from the point of view of plant capacity utilization, and the technical detailing we've done is for both the air conditioners, that is the one under the IFB brand and the one with basically an OEM possibly, to be both technically and aesthetically different. So it's not the same product. And we think that if it helps plant utilization and we are able to ramp up numbers faster than our internal project target, then that's a good thing.
Sir,
so that is the logic.
I get your point, sir, but here again there is a strategic conflict of interest. Because if you are supplying to any of the OEM, you are actually competing with him in the market and then providing him products in the back end. So that strategy of mix, how can this strategy actually be executed?
So it's a good question that you're making, because I think the conflict is probably more at the end of the buyer. Because for the buyer, they are buying from somebody who's competing with them in the market. So maybe IFB would not be so worried, but the buyer would probably be worried. But I think, and I cannot speak for the people who are talking to us, but I think that one of the possible reasons could be that it has become so expensive to import, and the urgency to basically localize is so high that people are interested to evaluate a good quality supply source that is available. That is the way I look at it.
Because, sir, the way I see it, apart from compressors, remaining 65% of the air conditioning is actually outsourced in India. There are bigger contract manufacturers available in India. And at this point of time, we don't have that much size and scale which can actually justify an investment of 150 crore rupees. Maybe we could have worked more on outsourcing model based with local contract manufacturers. And once we have size and scale, we could have ramped up this operation. That's the only concern.
So this is a point that we have been asked before in the investor calls, and the point that we made is that how do you get size and scale? You get size and scale by producing and delivering a product that represents the brand. For a brand like IFB, which is clearly positioned, differentiated, and very high quality. And we have done the detailing in terms of possible sourcing from within India, and it didn't match up to the quality levels that we want. And hence we invested.
Thank you very much, sir. I think
this is a very large segment, and we are very serious about it, and the investment is actually in that direction.
Thank you very much, sir. For more details, I will get in touch with you.
Yeah.
Thank you, sir. We have next question from the line of Kunal Bhatia from Dalal & Broacha. Please go ahead.
Yes, sir. Thanks for the opportunity. Sir, my first question was in regards to your tax rate. This time we didn't see any benefit on account of the new regime. So are we going to adopt that, or how?
So as of now, we are not being able to adopt that because we have MAT credit available. Unless till we use that up, we cannot go to the next regime, because once you get into the next regime, then you can't come back.
So how much would be the MAT credit available to us, and what would be the average tax rate for the current year and next year?
We have around 16.5 crores of MAT credit available.
Okay. And the average tax rate for the current year would be?
It would be the normal one.
Okay. And next year we expect to get to the 25.2%.
And again we have to see basically till this thing, if there are some more changes coming. We have to wait and see. But as of this year we are not using it actually. We are going to take the advantage of MAT credit.
Okay. And so just one more clarification. We mentioned that in case of motors, front load, the imported content is about 20%, top load is 15%. At the same time, we also mentioned that the current imported content in the front load is 25%, which is going to reduce to 20%. So I couldn't get the math here because
sorry, this is 20% of motors used are imported. That is what I meant. In
20%.
terms of the motors used, 15 to 20% are imported. That will go to zero. Okay. And the impact on the value imports for front loaders, it will reduce by about 5 to 6%.
Okay, so this is 20% of the motors used.
Yes, that's right. I mean, top loaders today, 100% of the motors are imported. And 40% is the import content in top loaders. So when all the motors get localized into India, that 40% will drop to 25%.
Okay.
By value. Have I been able to clarify?
Yeah. Okay, sir. Fine. Thank you. Yeah.
Thank you. So we have next question from the line of Rahul Gajare from Haitong Securities. Please go ahead.
Hi. Good afternoon, sir. Sir, I've got two questions. One, just continuing on the air conditioning discussion. Now, you all are looking at spending 140 to 150 odd crore. You already have tied up with an OEM, or you are speaking to potential OEMs right now?
No. As far as the OEM supplies from the factory is concerned, those are discussions which are still going on. They're not concluded.
Okay, fair enough. And the second is on the, on the distribution side. Now, you did indicate, that you have touch points of anywhere between 11,500 to 12,500 odd on a pan-India basis with, focus more on, making the dealers active. Could you just help me, what is the universe of these touch points for our kind of products? One, I'm sure, air conditioning will be a higher number and appliances will be slightly lower number. Could you just give me some sense on, what is the universe of these touch points?
So if you go by the total universe that we have surveyed, then if you look at all appliance categories, then the number is between 36 to 38,000 counters across India. And if you look at what is potentially addressable by IFB in terms of them selling the categories in which IFB is present or is going to be present, let's say like air conditioner, then that number comes in the range of, let's say, 24 to 25,000. Because there are many which sell only small appliances and things like that. So against that potential of, let's say, 22,000 to 24,000, today our presence is 11,500 to 12,000.
Okay, fair enough. The second thing is, you did discuss the sales breakup, in terms of online and own stores. Could you just help me with the number of own stores that you have, the IFB points that you'll have?
We have 535 as on date.
And what is the plan next couple of years to expand this?
So currently, we are looking at an incremental increase in this number, no major expansion, going up to maybe 600 by the end of the year, not more.
Okay.
And our focus for this year and for, let's say, the first half of the next year is going to be on the profitability of the stores, which means that we have franchisees and the franchisees should make adequate money.
Right.
We should ensure that we drive more footfall to the stores. So instead of focusing on more numbers, now we are focusing on ensuring that this is properly done before we take the next phase of expansion.
Okay. Now again in distribution, in terms of...
Would you like to come back in the queue? We have to take the next question.
Okay. Thank you.
Thank you, sir. We have next question from the line of Ravindra Naik from Sunidhi Securities. Please go ahead.
Thank you, sir. Sir, if you see the balance sheet that is for the first half of this year, you have done hardly around 50 crores or 55 crores roughly. Is it correct?
Sorry, could you repeat that?
the capex that you are planning the capex of 300 crores this year, and you have hardly done a capex of around 50 to 55 crores. Is it correct?
I will tell you, actually, we have capitalized around 20 crores as of now.
Okay.
We have 50 crores of capital advance and other things given. Another 15-20 crores is in the capital work in progress. But the major one that will be completed by the end of the fourth quarter. Okay. Then again you will get the full result. Because the things are in progress now, not capitalized.
Okay.
The capitalization will happen only when they are put to use. Okay.
Okay. So total capex what you have done currently as of now?
Like I said, that fully capitalized is around 20 crores.
Okay.
Capital advance is around 50 crores and there is some CWIP of another 20-25 crores.
Okay. So then another 200 crores capex will be done in the second half. Is it correct?
That's it. 150 to 200.
Okay. So do you see the debt level is going up by the end of this year, or?
There will be some debt will be there because till date we are not having any debt. We normally take some buyer's credit which we pay off by end of the year. But now, if we are going with some banking limit, there will be some debt on our this thing. Till date we have hardly any debt to have any debt equity ratio as such. But that will not be significant.
Okay. Okay, fine. Thank you.
Thank you, sir. We have next question from the line of Saurav Kinodia from Stewart & McCarthy.
Hello.
Yeah.
Sir, my question is with respect to the counter sales representative. If you can share the number of counter sales representatives we currently employ, and also if you can share the split for the same which are deployed at IFB points and MBOs.
So the total number of counter sales representatives, we don't employ them. They are on third-party roles. Is a total of 2,500 people. Out of that, 535 would be on the IFB own stores, which is the number of exclusive stores we have. And the remaining are all on MBOs.
MBOs. And is it possible for you to share the annual expenditure we are incurring on these people?
Mr. Chatterjee?
We'll discuss it with Saurabh separately.
Yes, sir. Okay. And sir, on this localization of the AC plant, will we be able to get the benefit in the Q4 of this financial year, or the benefit would start from Q1 of next financial year?
So the full benefit will come in Q1. We are trying to get benefits also in Q4, but the full benefit will come in Q1.
Okay. That's all, sir.
Thank you, sir. We have next question from the line of Akash Jain from Money Curves. Please go ahead.
Yeah. Sorry, sir, I got dropped off in between, so I may be asking a question that's already been asked. Apologies for that. I just want to understand, see, we are doing a lot of stuff in terms of margin expansion, like you said, right? There is we are putting up a AC plant. We are also introducing new models which are higher margins, etc. If I just want to get a broad sense, next year, on a like-to-like basis with a similar kind of product mix, what kind of gross margin improvement in terms of percentage can we expect?
As of now, it is very difficult to say exactly how much percentage it will go. Because still the AC plant is in full production and we understand.
But you have done internal work.
There will be some improvement in the cost.
I'm sure you've done some rough estimates. I'm just asking a rough estimate of what kind of improvement in gross margin can we expect with all these initiatives.
That is what I'm saying. It is very difficult as of now to give a exact guidance on this.
Okay. Okay. The second question is on working capital, sir. Given the impact because of lower primary and sales because of destocking, would you say that the debtor days for this September end is slightly on the higher side, or you are not too worried about the increase in working capital?
We are not actually. Traditionally during this period of the season, both inventory and debtor goes up, but by the end of the year it comes down. But not because we go strictly by the credit period.
So we are not seeing an increase in credit days. This is purely driven by the higher sales in the festive season.
Yeah, that's right. Right.
And sir, the last question is basically on the capex that we are doing on fine blanking, right? And clearly that business is going through a little bit of a challenging time because of the auto sales. Do you think it is the right time to commit a capex of 50 crores for fine blanking at this stage?
This is Arup here. Actually, what we are hoping that after the BS6 implementation, the volumes will grow up, and with every drop in requirements that customers place in the market, there would be subsequent increases with cyclical. So we should be ready with our capacity once it is launched. Now the thing is, because our capex is long, it takes a lot of time. It takes 11 to 13 months to install, from ordering to installation. So if the market rises and we order them, then we miss the bus. So keeping that in mind, and the order books what we have and we are going in for, we think we should be comfortably placed.
And what kind of capacity increase in percentage terms will this 50 crores capex provide us?
At least 50 to 60% of the time.
So if we are at 100, it will become 150.
Yeah.
Okay. Thank you so much, sir.
Thank you, sir. We have last question from the line of Rahul Gajare from Haitong Securities. Please go ahead.
Yeah, sir. Thank you once again. Sir, I was basically on the sales breakup. Could you please help me with how much does the canteen store account for in your overall revenue?
All direct sales, which is from the offices, from to CSD canteens, police canteens, everything put together is roughly 3 to 4% of company.
No, and direct sales together it is 5 to 6%.
5 to 6.
So CSD would be a subset of direct sales. That's what you're saying.
Yes, that's right.
Okay. Now, second, the last question really is, where are you planning to put this AC plant for?
It's coming up in Goa.
Okay. And land acquisition, all of that is done, or what is the status really?
It will go commercial end of January 2020.
Okay.
So it's in a very advanced stage.
Okay. Fair enough. Okay. Thank you very much.
Thank you, sir. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Chirag Muchala from Nirmal Bang Equities for closing comments. Over to you.
Yeah, thanks. I would like to thank the management for giving us the opportunity to host the call, and to all the participants for your presence. Sir, would you like to make any closing comments?
Thank you, Chirag. Thank you to all for participating.
Thank you very much.